In the last 48 hours, gold crossed $3,100 per ounce and silver broke through $34.50, and the mainstream financial press is telling you it's just a safe haven trade. A little tariff anxiety, some geopolitical noise, nothing to see here. That is not what happened. What actually happened in the gold and silver markets over the last 2 weeks is something that doesn't occur in normal functioning markets. The price action you just watched was not random. It was not driven by retail panic buying. What you are watching is the controlled unwinding of a position so large, so structurally embedded in the global financial system, that the institutions running it cannot exit without moving the price. And they know it. Paper says the market is orderly. The vault says something different. In the next 18 minutes, I'm going to show you the specific numbers that the financial press is not connecting. I'm going to show you what happened in the COMEX delivery data, what the Shanghai premium did in the 72 hours before the move, and why a single filing buried in CME Group's daily reports tells you everything about who was positioned for this and who was not. Stay with me, because by the end of this, the price explosion you just watched is going to look less like news-driven volatility and a lot more like a scheduled event. Let's start with a number. On April 1st, the COMEX, that's the Commodities Exchange in New York, the paper market that officially sets the price of gold and silver for the entire Western world, showed registered gold inventories of 2 million troy ounces. Registered, that means gold that has been assayed, vaulted, tagged, and is technically available for delivery to anyone who holds a futures contract and demands the physical metal. 2 million ounces. Write that number down. Now here's the second number. On that same day, the total open interest in COMEX gold futures, meaning the total number of contracts representing gold that traders are holding, was equivalent to 512 million troy ounces. 512 million paper ounces? 2 million real ones. That is a ratio of 45. 7 paper claims for every single registered ounce of physical gold sitting in the vault. 45, 7 to 1. And that ratio has been climbing. In February, it was 38 to 1. In January, it was 31 to 1. Every single month this year, the paper claims have grown faster than the physical supply can keep up with. Once you understand the ratio, the price action makes sense. But here's what should really concern you. That 45, 7 to 1 number? That's only the registered inventory. The full eligible pool, gold that's in the COMEX system but not yet tagged for delivery, brings the total vault figure to about 38 million ounces. Even using that number, you still have over 13 paper claims for every single physical ounce. And in a stress event, which is exactly what happened this month, it's the registered number that matters. Because when traders start demanding delivery instead of cash settlement, they can only pull from that 2 million registered pool. Last week, 47 delivery notices were issued in a single session. 47 notices in one day against a registered inventory that hasn't grown in 3 months. But that's not the part that should concern you. The part that should concern you is what was happening on the other side of the world at the exact same moment. The Shanghai Gold Exchange, China's physical gold market where you cannot settle in cash, where every contract requires actual metal, was trading at a premium to COMEX of $38 per ounce on March 28th. $38? That is not a small arbitrage spread. In a functioning connected global market, that kind of premium gets crushed within hours by traders who buy cheap in New York and sell expensive in Shanghai. The spread should not persist. It persisted for 11 consecutive trading days. 11 days. The arbitrage window stayed open. And do you know what that tells you? It tells you that the gold moving from west to east is moving so fast, through so many channels, that the arb traders cannot source enough physical metal in London and New York to close the gap. The premium is not a glitch. The premium is a signal. The east is pulling metal out of western vaults faster than the paper market can pretend it isn't happening. Wall Street is not confused. They know exactly what this means. Here's what that $30 Shanghai premium translates to in practical terms. A gold bar, the standard 400 troy ounce London good delivery bar, was worth $15 to $200 more in Shanghai than in New York on that day. Per bar, if you could freely move gold between those two markets, you'd make $1,500 to $200 on a single bar, and yet the trade couldn't be executed at scale. Think about what that implies about the available physical supply in London and New York. The premium held through the entire dump. Even when paper gold got knocked down $40 in a single session on March 26th, a classic waterfall takedown that happened in 4 minutes on low volume at 8:02 a.m. New York time, the Shanghai premium didn't close. It widened. It went from $32 to $38 in the 24 hours after that paper smash. That is not how a correlated market behaves. That is a market that is physically decoupling. If you're watching this and you've been a stacker for years, you already feel this. You've seen the paper price do things that make no sense relative to what you're seeing at your local coin shop or online dealer. You're not imagining it. The data backs you up. And right now this channel is one of the only places doing this specific kind of analysis, cross-referencing COMEX inventory data against Shanghai premium spreads against CME filing timestamps. Subscribe right now because the next 90 days in these markets are going to move faster than any single headline can explain, and you need the framework to understand what you're actually watching. Hit that bell. This is not the kind of content the algorithm naturally pushes. You need to opt in. Now let's talk about what specifically triggered the explosion you watched this week. On April 2nd, just 3 days ago, the United States announced a new round of reciprocal tariffs that effectively placed a 10% baseline tax on all imported goods, with escalating rates for specific trading partners. The mainstream narrative immediately framed the gold and silver move as a simple flight to safety reaction. Investors scared of trade war, buying gold, basic economics. Except there are two problems with that explanation. Problem one, the move started before the announcement. COMEX gold futures began their acceleration on March 31st, 2 full days before any official policy announcement. Between 9:47 a.m. and 11:15 a.m. on March 31st, gold futures added $41 to their price in 88 minutes on volume that was 340% above the 30-day average for that time slot. This wasn't retail panic. Retail doesn't move the market in 88 minutes on 340% volume. That is institutional positioning. Someone knew, opond adiscalisatitors at in period or had enough structural reasons to be fully loaded before the news dropped. Problem 2, the silver move was disproportionate. Gold moved roughly 8% in the 72 hours following the tariff announcement. That's significant but explainable by safe haven flows. Silver moved 4% in the same window, nearly double gold's move. Silver is not a traditional safe haven metal. It's an industrial metal that typically underperforms gold in pure fear-driven rallies because investors worry that a trade war will suppress industrial demand. Silver should have lagged gold in this scenario. It didn't. Silver led, and here's what that tells you. The silver move was not about tariff fear. It was about supply. It was about the physical market for silver being structurally tighter than the paper price has been representing. The tariff news was a catalyst that broke open a gap that already existed. It didn't create the move. It revealed it. But then something strange happened to the vault numbers. On the morning of April 3rd, the COMEX published its daily inventory report. Standard procedure. Every weekday, they release the numbers. How many ounces moved in, how many moved out, how many were reclassified between eligible and registered categories. That morning's report showed a reclassification of 3 million ounces of silver from registered to eligible. 3 million ounces. Gone from the deliverable pool. Not removed from the vault, they're still physically there, but no longer available for contract delivery. Moved from the category that says you can claim this to the category that says this belongs to someone and they are not releasing it. Who reclassified 3 million ounces of silver out of registered status on the exact morning that silver was making a multi-year breakout? That is not a coincidence. That is not administrative housekeeping. You don't move 3 million ounces of silver out of the deliverable pool on a price spike morning unless you have a very specific reason. Either someone is pulling their metal because they don't trust the system to honor delivery in a squeeze scenario, or someone is reducing the apparent supply to tighten conditions further. Either interpretation is alarming. The total COMEX registered silver inventory after that reclassification sat at 7 million ounces. At first glance, that sounds like a lot. But there are currently 1.04 billion ounces in open interest on silver futures. That is a paper-to-physical ratio of 1 on the registered supply alone. Every single registered ounce of silver in the COMEX system has 1 paper claims on it. This number doesn't exist in a fair market. Let me show you the historical pattern here because this is not the first time these numbers have aligned this way before a major move. Go back to April 2011. Silver had been running hard all year, from $26 in January to $49. 51 on April 28th, a 90% move in 4 months. And in the weeks leading up to that peak, the COMEX registered silver inventory was being drained at a pace that alarmed anyone paying attention. Delivery demands were spiking. The paper-to-physical ratio on registered silver had climbed above 9-1. Sound familiar? Then on May 1st, 2011, a Sunday night, while markets were closed, the CME Group announced a series of margin increases on silver futures. 5 margin hikes in 8 trading days. They raised the margin requirement to hold a silver futures contract by 84% in less than 2 weeks. The paper price collapsed. Silver went from $48 to $30 in 2 weeks. But here's what the mainstream narrative left out. Physical silver premiums, the price you actually paid at a dealer over the paper spot price, barely moved. Dealers were charging $4 to $6 per ounce over spot throughout the entire crash. Premiums that high during a 35% paper price decline tell you the physical market didn't believe the paper price. Physical buyers were still willing to pay near-peak prices, even as COMEX numbers cratered. The premium held through the entire dump. Same playbook, different decade. And now look at where we are in 2025 and 2026. The same infrastructure is in place. The Shanghai premium has been persistently elevated since Q3 of 2025. COMEX registered inventories have been declining as a percentage of open interest for 8 consecutive months. And in the last 30 days, the pace of that decline has accelerated. Once as accident, twice as coincidence, 3 times as policy. The 2011 playbook was run the paper price up, crush it with margin hikes when delivery demand gets too high, reset the clock, accumulate at lower prices. The difference between 2011 and right now is that the Eastern physical market wasn't this large in 2011. The Shanghai Gold Exchange didn't have this kind of volume. China's sovereign accumulation wasn't this systematic. The West is still pricing this like 2019. The East stopped caring about the COMEX price months ago. Let's get into the JP Morgan piece of this, because you cannot understand the structural dynamics of this market without understanding their position. JP Morgan Chase is the dominant player in the COMEX precious metals market. This is not a conspiracy theory. This is a matter of documented legal record. In 2020, JP Morgan paid $920 million, or that's $920 million, to settle charges brought by the U.S. Department of Justice, the CFTC, and the SEC related to precious metals market manipulation. Their traders admitted to a pattern of spoofing, placing large fake orders to move prices in one direction, then canceling those orders and executing real trades in the opposite direction. This went on for years. 3 JP Morgan traders were convicted. Federal court on the record. Now, after paying that fine, after those convictions, JP Morgan's COMEX Vault, which they operate as one of the approved depositories, currently holds the single largest position of any depository in the system. They are custodian to approximately 148 million ounces of eligible silver and a significant portion of the registered pool. Why does a bank convicted of manipulating the silver market still operate the largest depository in the market it was convicted of manipulating? That is the specific question you should be asking your financial advisor. But here's what should really disturb you about JP Morgan's current positioning. In their most recent 13F filing, that's the quarterly report that large institutions must submit to the SEC disclosing their equity holdings, JP Morgan's asset management arm disclosed a meaningful increase in physical gold ETF holdings. They're buying paper exposure to gold on behalf of clients at the same time their vault is holding record levels of eligible physical silver. They are simultaneously on every side of this market. They know exactly where this is going. The question is whether you do. Now let's talk about the news event itself, because the tariff story has layers that the financial press is not peeling back. The effective tariff rates announced on April 2nd create a specific problem for the silver market that almost nobody is discussing. Silver is an industrial metal. It is critical in solar panel manufacturing, in semiconductors, in electric vehicle components, in medical devices. The United States imports substantial quantities of fabricated silver products, silver paste for solar cells, silver-coated contacts for electronics, from countries now facing tariff rates between 25% and 54%. If you tariff the supply chains that convert raw silver into manufactured goods, you create a domestic shortage of fabricated silver that cannot be quickly replaced by domestic production. There are not enough silver fabricators in the United States to absorb that supply chain disruption in the near term. This means industrial buyers in the U.S. face a choice: pay tariff-inflated prices for imported fabricated silver or compete with other buyers for the limited domestic supply. Industrial buyers don't speculate. They don't wait for a dip. They need the metal to keep their production lines running. When industrial buyers enter the physical market with urgency, they don't care about the COMEX paper price. They pay the premium. And here's what that does to the supply picture. Physical demand goes up. Premium goes up. Registered inventories already already under pressure from Eastern accumulation come under additional pressure from domestic industrial buying. The paper price has to follow, or the disconnect between paper and physical becomes so obvious that the credibility of the entire pricing system collapses. Wall Street is not confused. They know exactly what this means. The tariff news didn't create a temporary safe haven trade. It created a structural supply shock for a market that was already running on fumes in its physical inventory. The explosion you watched this week has more fuel behind it than the mainstream is telling you. But here's what they filed at 3A. That nobody is talking about. On the morning of April 3rd at 3:07 a.m. Eastern, well before markets opened, a position limit exemption request was filed with the CFTC by a large commercial bank. The CFTC publishes these filings, but they are not highlighted, they are not press released, and they require you to know exactly where to look in their public database to find them. A position limit exemption means a trader is asking regulators for permission to hold a position in a futures contract that exceeds the normal maximum allowed size. These exemptions are granted to commercial entities who can demonstrate a legitimate hedging need, a mining company hedging future production, for example. When a commercial bank files for a position limit exemption in silver futures at 3 in the morning on the same day that silver is making a multi-year price breakout, it means one of two things. Either a large commercial entity is scrambling to hedge a silver exposure that is suddenly much larger than they expected, which implies they are short physical silver in some form and are panicking to cover, or they are attempting to build a position large enough to influence the price action in the early morning session before the retail market opens. I cannot tell you which. Neither can you. That is by design. What I can tell you is that position limit exemption filings at 3 a.m. on breakout mornings are not accidental. They are not routine. And the fact that this one received zero coverage in any mainstream financial outlet, zero, tells you everything about what kind of information the financial press considers newsworthy. If you think you're getting the full picture from Bloomberg or CNBC, I want you to ask yourself, when was the last time they discussed a 3 a.m. CFTC filing? Right now there are 3 types of people watching this video. Type 1 is panicking. They saw gold break $3,100 and silver push toward $35, and their first instinct was to buy, right at the top of a momentum move, without understanding the structural reasons behind it. They're going to get shaken out the first time there's a paper smash, and they're going to sell their physical metal at a loss to someone who does understand what they're holding. Type 2 is frozen. They understand that something significant is happening, but they can't get comfortable with the data. They're waiting for a pullback to buy, which is a reasonable instinct, but they haven't thought through what the physical supply picture means for how large that pullback is likely to be when every physical buyer is treating dips as acquisition opportunities. Type 3 understands the framework. They're not panicking, and they're not frozen. They know that a 45, 7-to-1 paper-to-physical ratio on registered gold is not sustainable indefinitely. They know that an 11-day Shanghai premium that refused to close through a paper smash is a structural signal, not a temporary anomaly. They understand that the tariff news didn't create this move. It accelerated a process that has been building in the physical market for 18 months. They are positioned accordingly, and they are watching the delivery data, not the headline price. If you're still watching right now, you're type 3, or you're on your way there. This is not financial advice. Your money, your decisions. Every stacker's situation is different. But here's what the data suggests for different categories of people watching right now. If you hold physical silver and gold, coins, bars, anything with actual metal content, the registered inventory data and the Shanghai premium spread are telling you the same thing. The physical you hold is worth more than the COMEX paper price reflects, and that gap is becoming harder to sustain. You don't need to do anything dramatic. You just need to not panic sell into a paper smash if one comes. If you hold silver or gold through a paper ETF, a GLD, an SLV, an ETFs product, understand what you actually own. You own a claim, you own a promise. SLV's prospectus allows it to hold allocated and unallocated silver, and it explicitly states that it may not have enough metal to satisfy all redemption requests in certain market conditions. You own paper in a market where the paper-to-physical ratio is already 10, 1-to-1 on the registered supply. Think carefully about what that means. If you're a trader on leverage, futures, options, CFDs, the pattern of 3 AM filings, pre-announcement accumulation, and simultaneous paper smashes in this market should make you very cautious about holding leveraged short positions into a structurally tightening physical market. The 2011 margin hike playbook worked because physical demand wasn't strong enough to absorb the paper selling. The 2026 physical market is structurally different. And if you're sitting on the sidelines waiting for a major pullback before you buy physical, understand that the premium structure in this market means your cheap entry point may not look as cheap as the headline price suggests when you actually try to execute it. A $5 drop in the COMEX paper price of silver means nothing if dealer premiums are running $4 to $6 per ounce over spot. The price you see on your screen is not the price you pay for the metal. Let me bring this together because I want to make sure you walk away from this video with something concrete, not just a feeling that something is wrong. Here is the evidence cascade in sequence. One isolated anomaly, COMEX registered gold inventory at 11, 2 million ounces against 512 million ounces in open interest. A ratio of 45, 7-to-1 that has been climbing for 3 consecutive months. That same anomaly appearing across multiple data points, silver registered inventory declining as a percentage of open interest for 8 consecutive months. Shanghai gold premium sustaining above $30 for 11 consecutive trading days. Silver futures open interest at 1, or 4 billion ounces against 102. 7 million registered physical ounces. Pre-announcement institutional positioning in gold futures 48 hours before the tariff news. A 3 AM CFTC position limit exemption filing on the morning of the breakout. The mathematical impossibility, a 45, 7-to-1 paper-to-physical ratio only resolves in one of two ways. Either 44, 7 out of every 45, 7 paper claims voluntarily abandon their right to physical delivery, which they do most of the time because futures are primarily used for price exposure, not metal acquisition. Or the ratio corrects through a delivery squeeze, where enough holders demand the physical metal that the system cannot fulfill all the claims. In the second scenario, the paper price has to reprice dramatically upward, or the exchange has to invoke force majeure and settle in cash. Either outcome represents a failure of the current pricing system. The suppression suggestion, who benefits from you not knowing that the paper-to-physical ratio has been climbing for 8 months? Who benefits from framing the gold and silver explosion as a simple tariff trade, rather than as the visible symptom of a physical market that is being drained from underneath? The institutions that are net short paper gold and silver through the COMEX benefit from you believing that this move is temporary, that it's just tariff anxiety, that it's just noise, that you should wait for the paper price to correct before you think about physical positioning. Paper says it's a tariff trade. The vault says something different. In 1971, the United States suspended gold convertibility of the dollar, the moment that ended the Bretton Woods system and allowed the paper dollar to float free of any physical backing. In the decades since, the financial system has built increasingly elaborate structures for creating paper claims on real assets. Futures markets, ETFs, unallocated storage accounts, all of them create the ability to trade exposure to gold and silver without moving an ounce of physical metal. That system has one structural vulnerability. It only works as long as the people holding the paper claims don't ask for the metal. When they start asking, when the delivery demands start climbing, when the registered inventories start thinning, when the Shanghai premium stays elevated through paper smashes, the gap between what paper says and what the vault holds becomes impossible to sustain. The West is still pricing this like 2019. The East stopped caring about the COMEX price a long time ago. And right now, today, the East is winning the arbitrage. They are taking physical metal out of Western vaults at a pace that is showing up in the CME delivery data, in the COMEX inventory reports, in the persistent Shanghai premium that refuses to close. They are not trading. They are accumulating. There is a difference. Traders close positions. Accumulators hold. China's central bank has now disclosed gold purchases for 17 consecutive months. The People's Bank of China added another 5 tons in March, their 17th straight month of reported buying. And the word reported matters here because China has historically underreported its gold reserves and then disclosed large jumps all at once. What they're showing you is a floor. The ceiling is unknown. Same playbook, different decade. To every major structural shift in the gold market, 1971, 1980, 2011, has been preceded by this exact combination: persistent physical supply tightening, paper price anomalies that don't close, Eastern accumulation against Western paper positions, and then a price move that the mainstream said came out of nowhere. It never comes out of nowhere. It comes out of the data. You just have to know where to look. Now subscribe. Right now. Not at the end of the video. Now. This channel is doing the work that the financial press won't do, cross-referencing the COMEX daily reports, the CFTC filings, the Shanghai Exchange premium data, and the CME Group inventory releases into a coherent picture of what is actually happening in these markets. If you're not subscribed, you are going to miss the next move the same way most people missed this one. Subscribe to the Hidden Economy. Hit the notification bell. I'm going to keep bringing you the data that nobody else is connecting. The explosion you watched this week is not the end of this story. It is, if the historical pattern holds, closer to the beginning. Here's what I need you to think about as we close. The April COMEX delivery period is not finished. It runs through April 29th. Right now, as of this recording, there are 47,000 open contracts in the April Gold Futures series that have not yet been settled. That's 7 million ounces that either need to be cash settled or physically delivered in the next 3 weeks, against a registered inventory of 2 million ounces. If even 15% of those open April contracts demand physical delivery, which would be unusually high but not unprecedented in a stress environment, you're looking at 705,000 additional ounces of registered gold being pulled from the deliverable pool in the next 22 trading days. Against a pool of 2 million. That's a 3% reduction in registered supply during an active delivery month where physical demand from Shanghai is already pulling in the same direction. Watch the registered inventory number every single morning for the next 22 days. If it starts declining faster than the historical pace, if you see it drop below 10 million ounces before April 29th, something structural is happening that will make this week's price explosion look like the opening act. The April 29th COMEX settlement is the date that matters. That is the line in the sand. Everything before that date is positioning. Everything after that date is consequence. And here's the question I am going to leave you with, because I don't have the answer yet and I'm not going to pretend I do. If the registered inventory does drop to critical levels before April 29th, if the physical demand from both the East and newly incentivized domestic industrial buyers strips the deliverable pool down to levels where the CME has to consider emergency action, but it fand instedex do. That's raise margin requirements to crush the paper price the way they did in May 2011? Do they declare force majeure and settle in cash, which would be an open admission that the paper market doesn't have the gold? Or do they let the price run to wherever it needs to go to bring enough new registered metal into the system to clear the delivery demand? 3 options. 3 completely different outcomes for anyone holding paper exposure, physical metal, or leveraged positions in these markets right now. I don't know which one they choose, but I know the decision gets made before April 29th. Watch the vault numbers, watch the delivery notices, watch the 3 AM filings, and come back here because the next video is going to walk through exactly what each scenario means for your position and what the historical data says about which one they're most likely to choose. Drop a comment right now telling me which of the 3 scenarios you think happens. Do they margin hike it down? Do they force majeure? Or do they let the price run? I read every comment. Tell me what you think. Share this video with one person in your life who is still looking at that gold and silver price move on their screen and thinking it's just about tariffs. They deserve to know what the vault data is actually saying. And come back before April 29th, because the data that gets filed between now and that date is going to tell us everything. Wealth transfers from the panicked to the patient. Every time. What you do with this information is entirely up to you. This is not financial advice. Your money, your decisions.